Welcome to the Keiser Report. I'm Max Keiser. There, but for the grace of bad English, goes the Japanese banking system. So said the ASO in charge of Japan's finance ministry. He said that, and I paraphrase, Japan's banks emerged from the global credit crime crisis largely unscathed because managers did not speak English well enough to understand the complex bogus derivative contracts that the scamsters from Wall Street had successfully pushed on other suckers from around the world. Yes, what dumb luck for the Japanese banks to have avoided Jamie Dimon's interest rate swaps only to buy a boatload of Japanese government bonds. Oh, Stacy.
Yes. So here we're going to introduce this first headline. Poor English saved Japan's banks from crisis. This is from Taro Aso, the finance minister, and he says many people fell prey to the dubious products or so-called subprime loans. Japanese banks were not so much attracted to these products compared with European banks, Mr. Aso told a seminar in Tokyo. Managers of Japanese banks hardly understood English. That's why they didn't buy, he said.
Well, I can understand where he's coming from on that. You know, when I used to do a lot of French TV, I would call Jamie Dimon and Lloyd Blankfein curse words and names and all kinds of scatological references to their being. And the French, of course, didn't speak English, so they would just say, yes, I agree with you. That's fantastic.
Well, but the other thing, of course, is that he could argue this. But the fact is also that the English-speaking bankers did not understand a single thing they were buying, or the pension funds or the small-time investors had no idea what all the gobbledygook of even though the words themselves were in English, it was all just a complicated mishmash of the words jammed together to hide basic, simple fraud.
Well, you know, let's break this down a little bit more, because in Japan, they were not required to buy the collateralized debt obligations and all the flora and fauna of derivatives contracts that came out of the imagination and the ASO of many of Wall Street's financial engineers, because all Japan has had to do these past 10 years is to allow their interest rates to trade near zero, the cheapest interest rates in the world, to become what's called a funding currency. All these collateralized debt obligations sold by Goldman or JP Morgan or Deutsche Bank are financed with the interest rate cheap money of Japan. So Japan is the well from which all the cheap money comes to float the global quadrillion-dollar derivatives market, and it has been that way for 10 years, and this is why that bubble's about to burst. So they're not required to buy these derivatives that ASO is talking about. That's not their role. Their role is to finance the creation of these derivatives. And so the fact that he's saying, well, we didn't get into trouble because we don't understand English, he's just trying to make a joke that all our banks are somehow sound. They're not sound. They're sitting on all kinds of bad stuff because they've been the funding currency and the kamikaze currency called the Japanese yen. Kamikaze currency, Japanese yen.
Well, Max, now the market language is the price signal. So I want to talk about the price signal that nobody no longer understands because it's no longer translatable. People aren't able to understand what is being said by the price signal. CME pulls wash trade proposal. Now, first of all, Max, what is a wash trade?
Well, wash trades are a way to manipulate prices, manipulate markets. So let's say Google stock is at $600 a share or $700 a share. You throw in orders simultaneously to buy and sell, washing those orders at a price that you want the stock to go. So let's say the stock of Google is $600 and you want the price to go to $605. You throw enough simultaneously buy and sell orders at $605 until the price gets to $605. So if you have options that are going to pay off at a $605, and then you throw a lot of wash trades in to get the price to $605, then you make money without taking any risk. Or if you make a mistake, then the state bails you out. It's called communism in America.
Well, that's what people will argue, that a free market is the price is always right. The price signal is correct because for every buyer, there's a seller. For every seller, there's a buyer. But here you're saying that the guy buying is also selling. He's trying to manipulate the price. He's trying to create a price. Now, the CME group introduced some voluntary reporting of your wash trades. So basically, they're making it a rule, but the CFTC has squashed this for now because they say wash trades are banned by U.S. law because they can feed false information into the market and be used to manipulate prices. Intentionally taking both sides of a trade can minimize financial risk for the trading firm while potentially creating a false impression of higher volume in the market. And Bart Chilton of the CFTC is saying that this is sort of what the high-frequency traders are doing. They're sending out loads of spoof trades and wash trades in order to create and benefit off from the rest of the market. They're scooping out wealth from the rest of the market.
Right. Well, instead of a price resulting from buyers and sellers in a process called price discovery, price is determined first or calculated first or mentioned first, and then you fill in the trades to get to that price. But this idea of there's no buyers without sellers, let's get back to the Japan being a funding currency as it relates to the Federal Reserve Bank and Jamie Dimon. So Jamie Dimon at JP Morgan, they'll put on a bunch of wash trades using 0% money to get prices where they predetermine them to go through manipulation. And then the buyer and seller, or the buyer of all the debt that they use to get to that trade, is ultimately the Federal Reserve, which is backstopped by the Bank of Japan and ASO and a 0% interest rate. So that's where all the risk is. The buyers are the governments who are sitting on hundreds of billions and trillions of dollars of bad debt that they keep having to float and roll by quantitative easing. That's the buyer of all the wash trades, ultimately, that have been used to manipulate prices. And of course, the Edward Snowden scandal brings in the other dimension where allegedly firms like Booz Allen and others and Deloitte Touche and KPMG are involved in the data selling to make this even less risky.
So in effect, quantitative easing is a sort of wash trade because here the government of the United States is issuing debt and then they're buying their own debt in order to create what they want it to be the price signal. They want to send a price signal about the strength of the U.S. economy, about the strength of the U.S. dollar, about the strength of the reserve currency of the world.
Right. They say, look, it's deflation because interest rates are so low. But they're engaging in wash trades, selling debt and buying debt simultaneously to create that low interest rate that they say is deflationary. Meanwhile, they're inflating the biggest bond bubble in the history of the world, which is, as we've been saying and warning about, is in the process of bursting. Interest rates are ticking up, and this will be a fantastic, glorious collapse of the central planners of the Federal Reserve Bank and other central bankers.
Well, the global, real, genuine world reserve currency, the world reserve money, has always been gold, and that's the other side of this trade of the wash trade, the one that actually can't be wash traded away. So we're going to talk about gold here in this headline because this is another price signal that nobody no longer understands. It's suddenly the price signals are speaking another language that nobody understands but the ones manipulating. So we're going to turn to a little clip from CNBC, and they interview Rick Harrison of Porn stars?
Yeah, Rick Harrison has a part-time job as a pole dancer over there in CNBC for Maria Bartiromo. She apparently likes well-endowed portfolios.
Well, he's a pawn star, so he runs a massive pawn chain, and he has 4,000 customers a day just alone in his Las Vegas shop. So here's what he was asked by CNBC, what he thought of the falling price of gold.
Is business different where you are because of what's going on?
You know, I retail a lot of gold and silver, and I'm having a real difficult time right now getting physical metal. It's the crazy world about gold and silver. Sometimes, you know, the paper market it's going down, but you can't actually find no actual physical items.
But that's another aspect to the wash trade of gold price suppression. If you want interest rates low and you want the price of the dollar to be high, you simultaneously, again, wash trading over different asset classes, price of gold to be lower. And as this gentleman points out from Pawn Stars, that the demand for gold has never been higher, but the price is dropping. That's a clear indication of price manipulation. Same thing with the bond market. The supply of bonds has never been greater, and the prices have never been higher in 300 years in the UK or 238 years in America. That's a complete repudiation of supply and demand and the price discovery and economics as we know it.
We've seen reports over the past few weeks of unprecedented demand, tens of thousands of people lining up outside gold shops in China, in Dubai, in India, in Vietnam, in Bangkok. And yet, the price that keeps on being talked about on CNBC is the price signal being chased by, just like cats, chasing one of those laser pointers. If you go to YouTube and Google it, you'll see lots of cats chasing laser points. And they're being steered in the circle by a false price signal. They're chasing a price signal that is lying.
I call that price propaganda.
Yes.
People react to a price emotionally, like a cat to a laser dot on the wall. And if you can manufacture a price, you can get the masses of people to pant like dogs toward that price. And if you see this Dow Jones at 15,000, and that's a manufactured price, you see all the YouTubers and the tweeters, clapping like seals on the beach, like, oh, that means something, arf, 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 even though it's a price propaganda, it's meaningless.
Well, and then finally here, in terms of understanding language and price propaganda, they combined in this final headline. This is a follow-up on the Anglo-Irish tapes, hashtag Anglo tapes. I'll probably punch Lenihan - drum. He told the world we are solvent. Now he can protect his €100 billion guarantee by writing us a €3 billion check. Get on with it. So this is David Drum, of course, the former CEO of Anglo-Irish, talking about his upcoming meeting with Brian Lenihan. And he said he was going to punch him and tell him, you've already offered us a €100 billion price guarantee. Just give us some money or else the markets are going to go crazy and investors are going to get scared and the population is going to be scared. Give it to us. Yeah, well, look, here's a guy who's threatening violence against the Irish people and who bailed him out. And I've said all along that bankers, to deter them, they should maybe face capital punishment. And some people have said, no, capital punishment is too much. You can't engage in capital punishment. And yet, we're talking about a banker who threatened violence against the bank and the state unless they gave him billions of dollars. So the Irish people, you're never going to win this fight unless you're willing to fight this fight. But, keep picking them shamrocks, whatever you do. Guinness, hello. All right, Stacey Hibbert, thanks so much for being on the Keiser Report. Thank you, Max.
Stay tuned for the second half. A whole lot more. Welcome back to the Keiser Report. I'm Max Keiser. Time now to go to investing legend and fashion plate, Jim Rogers. Jim, welcome back to the Keiser Report.
I'm delighted to be here, Max.
All right, Jim Rogers, gold has had its worst quarter in 30 years. Is the bull market over?
Well, Max, that's a very good question, and partly depends on how you define bull market. As you may remember, in 1987, stocks went down 40 to 80%, and many people said the bull market was over. Was it over? In retrospect, no, it wasn't, not at all.
All right, so...
And my point is that in my view, the bull market in gold is not over. It may go down another 20 or 30%, who knows, but by the end of this decade, it will be much higher.
Right, so the fundamentals that are supporting the gold market are still in place. Now, you did call for a pullback. Last year, you said you were looking for a pullback to satisfy, I guess, a healthy bull market has sharp pullbacks every now and then. Have we had that pullback now in this bull market? Are you satisfied? Are you buying, or are you looking for maybe a little bit more of a pullback?
I bought a tiny little bit just in case, but I would say, Max, I'm the world's worst market timer. I'm the world's worst trader. But I would suspect that a 30%, 35% pullback is not enough for it to make its final bottom. I suspect we're in the process of making a complicated bottom, which may take a few days, weeks, months, maybe even to another year or two. But then ultimately, gold will make its fabulous bottom, even if it's down 50% from its all-time high, and then we'll be off to the races again.
Okay.
Don't sell your gold, Max.
Fair enough. Okay, I want to stay on gold for a second. The price of gold is now lower than the cost of production for many gold miners. Barrick is writing down billions on one mine. So isn't this going to affect the supply of gold? And aren't the dynamics of supply and demand going to kick in here at some point?
Well, at some point. But, Max, I've seen many commodities stay below the cost of production for a year or two or three because people are very reluctant to close mines or close down oil fields or whatever it happens to be. It's very expensive to close something down and then start it up again. So it can stay below the cost of production for longer than we like.
I want to ask you really to put on your journalist hat for a second, because you're in Singapore, you're in Asia, and you can give us direct man-on-the-street reporting whether this is true or not. Are people lining up in Asia, in Bangkok, and in other places to buy gold, physical gold at the shops? Is this true?
Yes, in April and even into May there was some of that, but that seems to be, I'm sure there's still people lined up, but it's not nearly as much as it was the first time gold dropped.
Now, Jim, you've taught finance and economics at Columbia University. How is it that their demand for physical gold is so large and yet the price goes down? How is that possible, Professor Jim Rogers?
Yes, the demand is large, but if you're talking about people in the shops buying gold, but there are more people selling the ETFs, and that's gold as well. A lot of people selling that form of gold, and that's why the price is going down. Gold has rarely, if ever, been set in the physical market, gold prices, any more than wheat has. Wheat prices aren't set in the physical market. They're all set in the futures market.
Are you in the camp that believes that there are more paper claims on gold than there is gold in the physical existence? And what I mean is, it seems that there's an agenda here. Those that are supporting the paper market love to see the price of gold go down, and they're willing to even manufacture naked claims against gold, so-called naked short selling, to make that happen. Are you in the camp of those who believe this is what's going on, or what are your thoughts there, Jim Rogers?
Well, the same what I said about wheat. Yes, the futures markets in wheat are much larger than all the wheat that there exists in the world and always has been. When you say naked short selling, Max, that's not the way everybody who sells in the futures market is selling naked. There's no such thing as that's how futures are. When you sell gold or oil or wheat or cotton, you're selling naked. You may have it, but most people don't. That's the way those markets work. It's not like stocks where you can sell naked shorts or you have to be long or you have to borrow it. You don't have to borrow in the futures market. You don't have to borrow anything. Just call up your broker and start selling, or do it on the internet now.
Right. People can simply call up their prime broker, they can establish a line of credit, and they can start selling short gold all day long, no matter what the actual fundamentals are regarding that commodity. Now, I want to switch gears and talk about bonds for a second. The bond market, many people, yourself included, I believe, have been looking for a top in bonds. The bond market seems to be having reached that point now in a 30-year bull market in bonds. Have we seen the top in this bull market in bonds? It's been going on really almost your entire career, Jim Rogers. We've had the bull market in bonds. Is there now a reversal?
The bull market started in bonds in 1981 when it made its low in September of 1981. Been going up ever since. Now, Max, I've called the top in bonds 4 or 5 times and been wrong. But fortunately for me, the last 2 times I've gotten it right. So I have no idea if this is the final top or not. I am short junk bonds, not government bonds, and you can ask me in 3 years if I got it right or not. I don't know if this is the top, Max, but I do know we're getting closer and closer.
All right, let me ask you about a comment made by Richard Fisher. He's the president of the Dallas Fed. He called bond traders, quote, feral hogs, likening their reaction recently selling bonds to the news of the Fed tapering, that is to say, the Fed stopping their quantitative easing. He made the comparison to George Soros' attack on the pound. So here you have a group of market players that used to be called bond vigilantes and applauded for being bond vigilantes. Now Richard Fisher, the president of the Dallas Fed, is calling them feral hogs. Is that a bit unfair, Jim?
I know Richard and don't know him well, but I do know him, and he's a smart guy. I do know that whenever there's some kind of some comment from the Fed or anybody else, people react. Come on, Mr. Fisher, you know that as well as I do. He used to be in the investment business. If people get a report about cotton, they go and sell or buy cotton based on the report. So this is the way markets work. Richard knows this. Mr. Bernanke, who's never been right about anything, came out and said X, Y, and Z. So the markets reacted. What is he expected to do? Everybody just to say, oh, did you hear what Mr. Bernanke said? Let's ignore it? Come on, that's not the way markets work.
Now, you mentioned Ben Bernanke, and you're a critic of Ben Bernanke and the whole methodology of the Federal Reserve Bank, which mimics more of a Politburo-style central planning than free market. Here in the UK, we have now Mark Carney. He has taken over the Bank of England from Mervyn King. He comes in from the Bank of Canada. He's being lauded here in the UK as a savior, as a rock star of economics, as almost a Jesus-like figure who will save everyone in the UK and Europe. Your thoughts, Jim Rogers?
Max, go back and look at every time somebody has been appointed to the head of a central bank in the past 20 or 30 years. They're always brought in as rock stars. Bernanke was a rock star. Greenspan was a rock star. Neither one of these guys had a clue what was going on. They got it wrong over and over and over again. But every time they bring them in, the press, because of the government PR, says these guys are geniuses and they're going to save us all. Unfortunately for all of us, these rock stars have turned out to be men with feet of clay, and they haven't known what they're doing, and they're going to lead us all into they are leading us into a serious problem. Well, Mr. Carney has said he will print money just like everybody else. That's not going to save us.
Right. Now, it seems that the philosophy of these central bankers, including Mark Carney, is to look at asset prices and bond prices as their price signal that they work off of. But they don't seem to take into consideration other areas of the economy that are suffering. So they have a very myopic view of the economy and what they're supposed to do to manage that economy. How could these central bankers expand their purview to be more effective, or should we just get rid of them completely?
Well, the world, let's go to America first. America's had 3 central banks in our history. The first 2 disappeared, as you know, and the world can get along without central banks. Now, these central banks, if we don't have central banks, Max, we have problems, obviously, could have problems. These central banks are worse than having no central bank at all. Fortunately, since they're making so many mistakes, at least in the U.S., we're going to get rid of them eventually. They're either going to go bankrupt because they're making so many horrible mistakes, or eventually the public's just going to say, these guys got us into such terrible trouble, let's get rid of the central banks, as has happened in the past. Let's look at the Japanese central bank, since that guy is hailed as the hero at the moment. You know, he has driven down the value of the currency, the Japanese yen, by 20–25%. Now, that's great for stockbrokers and people who own stock. But there are 125 million Japanese, Max, and every one of those people is now suffering because the cost of living is going up. Everything they buy, there's more and more inflation. Yeah, he's helping a few people, but he's not helping 125 million Japanese any more than Mr. Bernanke or Mr. Carney is helping the rest of us.
All right, you mentioned Japan. Let's stay in Asia here and talk about China. It was recently reported that banks in China are relying on short-term funding, which may evaporate at any moment. It looks like a bit of a Lehman moment when suddenly short-term funding evaporates, and of course that was part of the 2008 crash. What's going on in China, Jim? I know you're an expert on China, but it really looks like are they in a credit crunch, or is that overstated? What's going on?
Max, I'm not an expert on anything. I would like to be an expert on something, but China is certainly going to have problems. You may remember 15 years ago there was a big Asia crisis where most of the Asian banks were doing that. They were borrowing long and lending short, and the whole thing collapsed. I'm not sure that's what's going on in China right now. The Chinese government and central bank has been trying to cool things off for the past 3–4 years now. All you got to do is watch RT-TV and you would know that, and most people should know that. And finally, it's becoming to bear fruit. They're starting to cool things off. It looks like it, and people are coming to them and saying, wait a minute, this hurts, this hurts. Well, it's supposed to hurt, for goodness sakes. When you cool things off, somebody has to suffer. Somebody's overextended. I hope China this time stays the course and does get rid of a lot of the excesses that have developed in China. They have too much inflation. They have a property bubble. They need to clean things out. Let's hope they do.
All right, Jim Rogers, we've got about a minute left. I wanted to ask you, again, something more of a philosophical question, putting your professor hat on for a second, and staying on China. China, the economy is really meeting now some environmental constraints. Now, according to people like Milton Friedman or other thinkers in economics, companies should never consider the environment. Their only obligation is to make a profit. That's their only obligation. But that kind of thinking in China and around the world is now meeting an immovable force called environmental catastrophe. So are you in the school where companies in China and around the world should just forget the environment, or they should try to mitigate their environmental damage, or is it time for another economic model, perhaps? Jim Rogers.
Well, Max, if your goal is to make a profit, that's fine, but you can't make a profit if you antagonize all of your customers. If your customers look out the window and they see horrible pollution caused by you, they're going to buy from somebody else. So you have to balance everything. Mr. Friedman is exactly right. The goal of capitalists is to make money. But part of making money is keeping your customers happy. And China now is starting to spend hundreds of billions of dollars cleaning up the horrible environment that has been polluted both in the air and in the water. Somebody's going to make a fortune, Max, cleaning up China, because they're spending a lot of money solving that problem.
Yeah, but those costs, of course, have been externalized off the company's balance sheet. It ends up on the government's balance sheet, and then the people end up paying this through higher taxes. So there's a bit of a mismatch with incentives and rewards. But anyway, Jim Rogers, we're out of time. Thanks so much for being on the Keiser Report.
Thank you, Max. Let's do it again sometime.
All righty. And that's going to do it for this edition of the Keiser Report with me, Max Keiser, and Stacey Herbert. I'd like to thank our guest, the legendary Jim Rogers. If you'd like to get in touch, tweet us at Keiser Report. Until next time, Max Keiser saying bye, y'all.